Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Daybreak Asia podcast. I'm Brian Curtis along with Doug Krisner. Join us each day for the stories making news and moving markets in the Asia Pacific. You can subscribe to the show anywhere you get your podcasts and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.
Let's bring in our guest. Rebecca Walser is with us. She is president at Walser Wealth Management, joining us here at the Interactive Broker Studio in New York. Thanks for dropping by.
So glad to be here, Doug. Thanks for having me.
Are we talking about a soft landing now when you look at kind of what the Fed is signaling and then the data that we had today, particularly the second quarter GDP number?
Oh gosh, I hate to be such a contrarian, but I wish I could say yes, Doug, but I just don't see it. I wish I did. I know the retail numbers are great, but I'm looking at the forward guidance of the consumer, and the consumer is really telling us that they are out of cash to spend. I know retail sales have been good, but that's always historical data, right? So we're looking forward, and we're seeing that consumers, we have the highest credit card balances, 1.3 trillion in the history of our country. Our delinquency rates are astronomically accelerating. Our car delinquency rates are accelerating. So, Doug, the stories aren't matching up with the GDP numbers showing such good, strong consumer spending versus where we know the consumer is right now. So that's what I'm talking about, the future. Okay,
so the equity market then should be pretty worried when it comes to earnings, right?
I believe so. And I do think that we've had some, Mag 7 not great numbers this season. And NVIDIA was great. I double beat, absolutely great. But the guidance was still, saying, it was a reassurance that their market has got a long runway. But Doug, when you look at the guidance, people are still wondering, how is this going to be monetized? And if these other commercial buyers of NVIDIA chips for AI are not able to get a return on investment fast enough, are they going to be pouring the billions and billions that are going to NVIDIA that are giving us these crazy astronomical 3,000% growth in 5 years?
The autumn can be very rough for the equity market. We're a week away from September. Are you braced for some downside?
Absolutely. I mean, this is the most shallow depth that we have seen. I mean, look at the concentration of Mag 7 in the NASDAQ, in the S&P 500. This is awful concentration in it. So if anything goes wrong, and when you look at the Middle East and you look at Russia, Ukraine, and you look at all the things geopolitically that are going on in the middle of an election season, in the middle of, we've got all of these pandemics. The WHO has declared a new pandemic of Mpox. So you have so many factors that any one of them pops off when you have such a weak economy. The fundamentals are so weak, then you should expect a really, unfortunately, an oversized response to anything that is on the outside that will be affecting it.
So you mentioned the election. I'm curious as to how that's affected your thinking on markets these days.
I think that obviously with the Trump administration, we would be more business friendly. We don't really know where Kamala's positions are economically. I'm really looking forward to this 9 o'clock interview. I'm hoping that she actually does go more into the economics of her plans because, Doug, her first kind of things that she's talking about are price controls. And all of us are bracing and saying, where is this coming from? This is not anything that we were expecting to hear. So for me, we're really looking for more details on what is her economic positions now.
Speaking of the economy, how do you think the Fed has been doing it, kind of getting away from ultra-tight monetary policy? We got an indication, pretty strong one, last week from Fed Chair Jay Powell. We're looking at a rate cut as soon as the September meeting. It could be as much as 50 basis points, although I don't think when you look at what the market is telegraphing, it's more likely 25. How do you feel about rate cuts going into the end of the year? Is it possible that we get a total of 100 basis points in cuts?
Well, I think that would be difficult if we only get a 25 in September on September 18th. So we'll see, but I don't think the Fed is going to go to a 50-point cut swing as fast as September. One, because it's so close to the election and that can kind of be couched as political by people that don't appreciate that. But two, it also really, Doug, sends a more fundamental message to the global economy that something is wrong fundamentally underlying. And if you look at, we had the second largest retraction of jobs, 818,000 last Wednesday. Wednesday. And that's on top of all of the diminutions that we had monthly, all the corrections. This is the second most corrected BLS that we've had since 2008 and 2009. So obviously those numbers were just coming in way over, too extreme, and they were brought back down as they were corrected over the months. But then the annual correction almost took another 1 million jobs away from last year. So that is where you're seeing Powell come back in and saying labor is definitely now a concern. We're seeing the softness. And so he's looking at a cut. But if we have to go to a 50 basis point cut, that is signaling that there's something even more alarming going on.
Where are you seeing opportunity in markets these days?
Obviously I hate to say it, but the breadth or the long-term runway that we really do think is the AI tech space. And that's why the whole world is invested in it. So there is common sense there. But, you have to look at, if we're going to go into a recessionary worldwide kind of period, where are recessionary places? And that's always going to be your consumer, defensive, your staples, your utilities, your commodities. So we would look at if we start to see really moving towards more weakening economic data, then we would look at more defensive positions.
Are you worried about recession at all?
I am because, you look at Germany and their manufacturing is depression level. You look at China, we know what's happened there. You just mentioned yourself, Japan is slowing. Everything is slowing globally. And really, if you think about it from my perspective, it starts kind of in the East with the Asian exporters, and then it also moves to Europe, the European zone, which we know how that is going with Germany. And it really then comes to America. So these have already kind of been going through the slowdown, and it's now coming to us. And we are the world's reserve currency, which helps us, export our inflation as much as we possibly can. But there is a day, Doug, that we have to pay the piper to. So
if we can agree then that places like Asia and Europe have been slowing for a while, maybe there's opportunity in those markets. What do you think? Well,
I can definitely tell you that I don't recommend anybody go out and borrow yen and buy and do investments in dollars. So because the carry trade that we know came up on August the 5th is far from being over with. So be careful. Just be cautious, because right now, if we go into a kind of global financial, and you have to understand too, Doug, this is the first time that we are really seeing global economic interplay so vastly that as China, potentially collapses, as Japan, I'm not saying it's collapsing, but I'm saying as these things happen, we are so dependent now, as they're the exporters and we are the importers, that what happens with them is going to come to us. So we just have to be very cautious.
So do you like the bond market there? If you're a little concerned about growth going forward and the Fed is going to cut rates, we don't know by the magnitude, but Are you seeing opportunity in the bond market?
I think that the bond market always does well in a period where there's less interference by central bank policy. So that's where we have to see, where are these central bank policies taking us? We know they're implementing Basel III, and that's why we've seen all of this gold purchases by all of these central banks around the world. How does that impact what the central banks are going to be doing? But you're looking at just even here in the Federal Reserve here, we're in a net negative interest rate situation. We're normally having the Fed send the Treasury interest on a monthly basis. That is costing us money right now. So the Fed's balance sheet at $7 trillion, it still needs to come down. To your point earlier, you said, how are we slowing down the tightening? Well, we reduced quantitative tightening from some 90 billion to some much less, 60 billion less. And that has helped our economies be sustainable. But now we're at the point of cuts. And so I would be more concerned about yields in the short term.
Just want to point out that everything that the Fed earns on its balance sheet is deposited at the Fed's account in the U.S. Treasury. So it's a way the government can make a little bit of money at the margin, right? That's right. Let's do some walkabout economics. You're based in Florida. How is the economy in Florida holding up?
I think that for us, I'm in Central Florida, Tampa, and we're still seeing just a massive amount of relocations business-wise. We still, our property in the commercial space is actually really tight. Our inventory is low. As far as the, retail and consumer housing, the inventory is ticked up just like it has across the country. But we are still seeing a really tight commercial retail availability. So that is really just because of a lot of businesses relocating to the state of Florida. Florida, state of Texas, from other states that are maybe more restrictive and more expensive.
Miami in particular, too. Do you get down to Miami at all?
Yeah, I do, absolutely. And it is just Florida just feels like a different part of the country right now. Everyone else seems to be sort of slowing down. And I just know Florida, Texas, Arizona, these countries are really growing their net, businesses, which is great. But it is a problem. I'm in between of moving office spaces, and it's been quite a challenge in Tampa, just securing office space and doing a build out because of how much activity is going on. It's crazy. It's like we're living in two different worlds.
Rebecca, a delight to have you on the program here in New York. Rebecca Walser, president at Walser Wealth Management, joining us here on Daybreak Asia. Let's bring in our guest. Thomas Todd joins us. Thomas is head of APAC investment strategy at BlackRock. He joins us from our studios in Hong Kong. Good of you to drop by. I hope you're doing well. Are you still constructive on markets, generally speaking?
Hey, Doug, how you doing? Good to be back. I think for the most part, there are some shifts that we've been making over the last month, particularly around the U.S. market. Not essentially telling investors to sell out of positions, but maybe take some rotation and beta off the table. I mean, the U.S. economy looks relatively strong. There's a little bit concern about the labor market and perhaps that weakening. But earnings growth across most sectors has done pretty well. I think, in terms of taking the bait off, it's more about the rotation trade, which we see continuing, particularly into some of those small caps and companies that are more aligned and more sensitive to Fed funds rates in terms of borrowing.
I have to ask you about the AI trade because we were kind of breaking down the NVIDIA results yesterday after the bell, of course, and the fact that the revenue forecast was a little disappointing to some who have been very optimistic about the rate of sales growth continuing. I mean, when you look at some of these AI stocks, are you still a buyer of the thesis? Are you still willing to put new money to work in these names, or maybe it's getting a little toppy here? What do you think?
Yeah, I think not just now. NVIDIA is obviously the kind of the poster child for that trade. And in terms of the AI story, obviously it's a long-term story. I think what's basically happened is, we've had a lot of rhetoric around what AI means for productivity gains, et cetera. It's very hard to quantify that. The initial phase of that investment leg was around basically buying hardware and chips makers, semiconductors. That was kind of the first rotation we've seen. And then we have investors looking at, okay, what's the actual next leg of this? Is it cybersecurity? Where do we go after this? So I think, we're looking at it as a longer term thematic. It always concerns me when the entire market is looking at the earnings calls of a single company in the S&P 500. So I think in terms of concentration risks, they are there. But I think the AI story is more of a long term, but probably it's one to revisit next year. Are
you equally as cautious on some of those high bandwidth memory chip makers, less SK Hynix in South Korea, along with Samsung? Are you cautious?
Well, I don't look particularly at single stocks, but certainly, if you look at their holdings or their weightings in the South Korean stock index, or KOSPI, or the Taiwan stock index, it is a little bit concerning. They're about 25% of both. And when we look at the general portfolio, we are talking about how do we take some of the growth exposure, the tech exposure away from that, and moving into Q4 and also into next year. It's about looking for economies that are more driven by domestic factors rather than global factors as we move into U.S. elections. So South Korea, Taiwan are not in that bucket. It's more kind of India and Japan, at least on the larger exposures.
You read my mind. I was wondering about Japan, the domestic demand story there, but the retail sales number that we just had for July was very disappointing. Half of what the market's looking for here. Is there something to be concerned about now?
In terms of the next leg of the structural bull story in Japan, it is about the domestic consumer. You have to bear in mind that for 40 years they've had basically zero inflation or disinflation, and so it's going to take a little bit of time for that consumer mindset to change. We are seeing some signs that we're getting more investing through NISA programs and things like that. But there is a lot of money sitting on the sideline in Japan, somewhere around $7 trillion in in cash. And inflation is going up. The stock market did have a brief drop, and I think if you look at the foreign investor positioning, it's kind of the index money kind of moved out very quickly, and now it's kind of more of an active story, finding those companies with actual earnings growth that benefit from structural reform. So it will take some time, and there is a lot of faith being put in that consumer story. But I think that transition is going to take a little bit of time. But we're still bulls on Japan.
A few hours before Jay Powell spoke at the Jackson Hole Symposium, we heard from the governor of the BOJ, Kazuo Ueda, talking about the possibility, the likelihood that the Bank of Japan would continue to raise interest rates. Yeah. Might we see a rate hike between now and the end of the year from the BOJ?
I think so, yeah. I mean, I don't think it's going to come in September, but I think October is definitely a possibility. Inflation is trending up. And so, I think that's definitely a possibility. In terms of the JPY movement, it's very basic, but we also have to understand that the BOJ moves in increments of 10 bips and the Fed moves in increments of 25 bips. So net, I think that there's still the possibility that we get some repricing on 4 rate cuts this year. So I do think that the yen will continue to appreciate, but we could see a little bit of a depreciation going into end of year.
To what extent would we have a much better Japanese economy if the Chinese economy were doing better than it is?
I mean, I don't think it's that relevant. I mean, currently, again, moving into U.S. election cycle, we're looking at those economies that are more exposed to China trade, China growth, and U.S. trade and U.S. growth, and basically trying to find economies that are more domestically driven. Japan is obviously a big exporter, but one of the things that we're looking at in Japan now is basically moving away from those broad export-driven indexes, topics, for example, more into kind of the granular high dividend type of exposure. So the trade with China is important, but again, we're kind of more focused on the domestic story here.
So if it's the domestic story, then you avoid China at all cost, I would imagine, right?
Well, I mean, I think for the most part, foreign investors have been avoiding China at all costs. But actually, China is very much driven by the domestic retail. That's kind of the issue, is that growth hasn't been there at all. So until that picks up, I think foreign investors are just going to stay on the sideline when it comes to China equities.
Tom, it's always a pleasure to have you on the program. Thank you so much. Thomas Taw, head of APAC investment strategy at BlackRock, joining us from our studios in Hong Kong here on Daybreak Asia. Let's go to Singapore, bring in Bloomberg's Mary Nicola, who is one of the M-LIV strategists in the APAC region. I was looking at the M-LIV blog right on the Bloomberg terminal, and I see that you had a posting earlier in the day. What was the genesis behind this? What caused you to write about the subject matter that you unpacked today?
Yeah, I think the main thing, especially with what we've seen with the equity markets, we've been so focused on NVIDIA and how NVIDIA plays out into the rest of the markets. But the key thing here is that even though we had a weak day because NVIDIA dragged down the S&P 500, most stocks advanced, and you're seeing this broad-based rally and a sign of a more sustainable rally, because now the focus is not only shifting from the Magnificent Seven to the rest of the 493, and that actually bodes very well for a more sustainable and broad-based rally.
Do you think that the pivot on the part of the Fed chairman last Friday had a lot to do with what you're describing here in terms of a broadening, where the market can feel that there is some wind at its back?
Well, it also helps, too, that Q2 earnings were quite strong for the rest of the 493. I think that's another key important factor to consider. So it's actually that fundamentals are working in their favor as well. Of course, the fact that the Fed is pivoting and we're looking for cuts to come as soon as September is another one. But I think the fact that the fundamentals are also playing in favor and valuations are actually looking better and brighter for the 493 says something for equities.
So if you were to compare and contrast the gains that we have seen for the U.S. equity market versus, let's say, the U.S. bond market, not just treasuries, but corporate bonds as well, what do we know about that relationship?
Yeah, interestingly, we've had over the past few years that there's been this positive correlation, right, between bonds and equities. So as especially, and they haven't, usually there's a negative correlation where the stocks, when they underperform, bonds outperform. However, over the last year, sometimes when you see the bonds underperforming, equities are also underperforming. And we've seen an underperformance in bonds for quite some time. So now we're seeing that the comeback of that negative correlation coming into play, which is actually supportive, because if you're a manager, like I was at some point, and you're managing 60-40, now your gains are being buffered. So let's say you've got some losses in the equity markets, and the recent losses, they're being somewhat buffered by the fact that you've been gaining on duration and on bonds. So we have seen bonds gaining traction as a result of the Fed. And it's a question of, does that continue, or is everything already priced in?
So when you're describing what the expectations are for cuts in interest rates from the Fed, I think I'd like to talk about the dollar here and get your views on whether or not you're expecting much more in the way of dollar weakness. We've seen a fair amount already, I think, down about 4% since Jackson Hole. Is this something we can expect more of, more dollar weakness? And then what made that do to some of the EM currencies that you track closely there in Singapore?
Yeah, I feel that the dollar is always and forever about rate differentials. And if rate differentials are still working in the favor of the dollar, it's hard to see the dollar weaken too much. And that's where it comes in, where if, let's say, the Fed goes aggressive and starts hiking and starts cutting rates a lot more aggressively than we expect, then sure, the dollar is going to struggle. But if it takes a more methodical and cautious approach, it's hard for there to see further weakness in the dollar if their nominal yields are still above, several currencies within G10 and as well within emerging markets.
When you look at what some of your colleagues are writing on the M-LIV blog today, is there anything that was kind of jumped off the page, so to speak, to you? Anything that's interesting?
Yeah, one of my colleagues actually wrote about, rising EM rate expectations and the ability, and that being an underpinning for EM currencies, and the fact that as the Fed prepares to cut, that's going to be supportive for EM. And I think it supports a lot of the high carry, so a lot of the emerging market currencies with higher yields. I think it doesn't bode as well for a lot of the currencies with lower yields. And a lot of them are in Asia.
It was interesting. We were talking about the tariff story as it relates to some of the Chinese electric vehicles a moment ago. Do you think the tariffs have the potential to play a big role in holding back some of the growth in China going forward?
I think so. I think it carries a lot of reluctance for companies to invest and private companies to invest. I think that's been, and we've seen demand has been exceptionally sluggish. Exporters, multinationals are hoarding onto cash, onto U.S. dollars, and a lot of it has to do with the fact of there is this overhang of what is happening within the markets about tariffs, and I think if that continues to linger, you will see that that's going to have broader implications on the Chinese equity markets and on the currency as well.
Daybreak Asia, that's Mary Nicola. Let's bring in our guest, Yuqian, head of China Autos Research at HSBC, Qianhai Securities. And Yuqian joins us from our studios in Hong Kong. Good of you to stop by. Thanks so much. Can we talk about the disappointment that we saw yesterday in some of those EV makers? What's happening with the EV makers in China right now?
Yeah, thank you for having me. I would say for the first 25 days of August, the EV penetration in China breaking 55%. So EV is now materially the majority of the mix in China. So, but in terms of the earnings season, there's a lot of expectation play too. So when we're talking about stocks, I would say that's a little bit different. Last night, the ADR EV stock had a strong rebound, although the other day, it was a little bit a roller coaster. I think the second quarter print so far we've got from the EV makers are generally strong, but the market expectation or the market focus has been pretty much hinged on the second half outlook. Some of the company didn't talk much, so the market got a little bit disappointed and it overshoot the night before last night, but it rebounded last night. So I would say generally we are sailing into a high season in September and October, and the China government has doubled down the trading subsidy on the EV side and also on the ICE side. By the end of July, we're seeing more follow-up policy coming in August. So we believe the double down of the policy support and also the high season coupled with a strong new model supply pipeline into September and October should boost the marginal improvement from the whole sector perspective, especially benefiting the ones with the new model coming, such as BYD, XPeng, and NIO.
Just a quick, this is Mary from Singapore, just a quick question for you. So we've seen a lot of discussion about tariffs on the Chinese auto industry. How is this affecting some of the investment, the ambition of some of these automakers?
Yes, indeed. The global trade environment is challenging and complicated. I would say from the China export perspective, currently EV is the highlight, but it's only about 20 to 25% of the mix. We do expect, given the product strengths and the competitiveness of the whole industry, that there should be more growth opportunity down the road. But emerging markets such as ASEAN, South America, and the Middle East could be the key focus in the coming years. While in some developed markets, given the tariff barrier, it could be proved to be a little difficult. So again, there's still room to go, but it's more emerging market focus on the China EV side.
So you could make the case then that the tariff really is a response to very low pricing. And you could also make the case that China right now, given a lot of the overcapacity, and I use that term cautiously, I know it's up for debate, but that China is attempting to kind of export some of the overcapacity to markets offshore, the United States, or maybe areas of Latin America, parts of Europe as well. Do you think there's going to be a lot more forced consolidation within the EV manufacturing space in China because of this issue of so-called overcapacity?
Great question, but a couple of them. So let's break it down. So I would say actually the China EV is not competing on low price in the overseas market. Taking BYD, for example, its European pricing is almost twice as versus what is in China. In the rest of the globe, it's also having a high premium over 50% versus the China pricing. So it's not really competing on the low price. And another aspect about the China EV going global is part of the production has now been localized. It's not just made in China, shipped abroad. BYD just completed their Thailand plant, and they're going to open the Brazil plant next year, Indonesia plant the year after. They're also building two plants in Europe, in Turkey and Hungary. So the localization should mitigate part of the tariff risk because they want to be more committed to the local market. So these are the two angles we would context into the broader China EV competition debate. And also consolidation is more like a domestic topic. Yes, we do see the domestic consolidation happening in China. If we're talking about the top 10 EV makers, consolidation rate is increasing from 70% 2 years ago to close to 80%. So we do see the consolidation happen. Small players got phased out, squeezed out. There's less brand left, but still the status quo is still too much. And we're in the middle of this. During the process of consolidation, it could be a temporary value destroy for the space. But when we reach the inflection, the pricing environment should be able to get better. But we're still in the middle of this. And some of our EV companies leader talked about 24, 25, 26 could be the consolidation year. So we are now right in the middle of that. But it is happening in China.
So tariffs aside, what do you think is the biggest risk for earnings growth for these auto companies?
I would say generally the tariff in certain markets, such as US and Europe, is in full discussion. So we know where the risk is, where the debate. The company has their strategy formed out, more emerging market driven already. And for the places with the tariff, the local plant has been building. Of course, that there will be higher execution costs and longer execution time, but that's the proper way to mitigate the risk to the most and also build the business into the midterm for longer. So generally, I would say it's largely priced in with the current market expectation for what has been announced, what's in the news, in the price. And for the rest, I think I would stress that the localization plan has been in progress. That should help the potential tariff risk should there's more.
So we've talked a lot about in terms of what the foreign markets would be for some of these Chinese EV makers. Let's talk a little bit about what's happening domestically in China and the extent to which some of the European manufacturers are being squeezed out. Is that going to continue at a pretty healthy clip?
I would say the consolidation coupled with electrification or the EV transition are the two themes. So different OEMs are tackling that with different strategy. Of course, if you have a strong EV pipeline from the pricing perspective, that should be able to remain relatively more dynamic. I would argue some of the incumbency company, the ICE makers, probably under the near-term pressure because consumers prefer EV. And consumers prefer advanced software experience. For the ones that the model is not up to the ballpark market average competition requirement, the market share losing in the short term or the pricing discount is probably something we would expect in order. So I think it's largely about the product strategy, whether you can get the right EV product right. Maybe you get it in the next generation, but against the very strong competition, very strong model supply, the rope-a-dope time, probably pricing is something you have to pay for the near term.
Mary?
Just one last question is, you seem quite optimistic. What are some of the risks that you see besides the tariffs?
Of course, I would say two sides. What we discussed, I'm also concerned. Of course, the trade environment is quite important for the overseas expansion, the footprint, and the local execution. And domestically, the competition, the pricing pressure might continue for a while. Although we would argue the pricing pressure is on and off. There's a seasonality, there's a model supply cycle, there's a different strategy coming from the leaders. So there's a mixture of things, and on top of that, I would argue the demand side of the risk is constantly tangible. So if the demand is working their way out, the pricing should be easy. But if there's limited demand, you will see the OEMs will try to compete more aggressively for the limited pie.
So maybe lower interest rates helps things out. We'll have to wait and see. Yuqian, head of China Autos Research at HSBC, Qianhai Securities, joining us from our studios in Hong Kong here on Daybreak Asia.
This is the Bloomberg Daybreak Asia podcast, bringing you the stories making news and moving markets in the Asia Pacific. Visit the Bloomberg Podcast channel on YouTube to get more episodes of this and other shows from Bloomberg. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen. And always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.